How are you doing? This is David W. Williams, also known as Diamond Dave. Now, the word is out that Affirm and other companies that try to sell their asset-backed securities can't develop that same type of market for those particular securities that they currently had over the past 1 to 2 years. What we're going to look at in this particular video is how do we think that these companies are going to move in the future, seeing that a market no longer exists for their asset-backed securities. But to really kind of get a better understanding of what this means, let's watch this really quick video on what an asset-backed security is, because for a lot of people, it's going to be something that they never heard of. And I want them to really kind of understand the marketplace for this particular security, because once you understand that, then you can really understand what these companies are actually doing and the marketplace they actually exist in. Let's go ahead and watch this video real quick.
Asset-backed securities, or ABS. It's a familiar phrase, but what exactly does it mean? Imagine a business owner gets a bank loan to buy some real estate. If he can't pay back the loan, the bank has a problem. So how does the lender deal with that risk? One option, the lender bundles together these loans into larger products and sells them off to investors. Then it's an asset-backed security, or ABS. It sounds like a win-win solution. On the bank side, when many smaller loans are bundled together, they're easier to sell. And for buyers, asset-backed securities can be an attractive investment. Investors snap them up.
Now that we've seen this video, let's get a bit deeper into this article. Now that you understand what an asset-backed security is, what role it functions in the market, we're going to continue to talk over and over again on this channel is that people are always looking to get a return on capital, or what we call an acceptable yield, based on the risk that they want to take and based on the amount of time that they want to get that yield in. And once you really understand that principle of these markets, you understand what's driving all the marketplace back to activity. If you don't understand this, then you allow other things to distract you from what's actually going on. Everybody's trying to get a return on their capital that is acceptable from the risk standpoint and based on the amount of time they want to get that return on. Let's get a little bit deeper into this article. So this is from the Wall Street Journal. Some companies pull back on securitizations as investors seek higher return yields. Let me go ahead and pull this up. So what we see is that fintech holder Affirm and auto lender World Omni Financial Corp are examples of companies that recently pulled or delayed planned transactions. We see that issuance of asset-backed securities in the U.S. dropped 45% this March to 79.4 billion, compared with the same period from a year-to-year standpoint. And the decline was largely due to a lower issuance of securities backed by corporate debt, right? Other factors such as decline in loan originations or consumer confidence can affect overall issuance. We also see that by comparison, U.S. corporate bond issuance dipped 14% over the same period to 521. So that's the chief capital officer at Affirm. So Affirm, which specializes in buy now, pay later transactions, last month decided not to move forward with a deal, determining that it would not receive the pricing it's wanted. So what do we mean is that the market doesn't have the same appetite for asset-backed securities from Affirm than they normally would. And what it really means is that Affirm is saying, we can't pay the yield that the market desires, right? So now what Affirm is doing is going to have to try to figure out a new way to generate capital for whatever they need it for. So the market is demanding a certain yield back from Affirm to buy their ABSs. And Affirm is saying that we can't accept those particular terms. So Affirm in recent years has increasingly relied on securitization to fund its rapid growth, viewing the market as providing a relatively efficient source of funding. So as December 31st, Affirm had funded about a third of its 6.3 billion loan portfolio with securitizations. The remainder was funded with a mix of direct loan sales and warehouse funding, in which the company borrows against its consumer loan balances. This is the kind of information that you want to know to really understand the actual market that this company operates in. So on face value, you look at this as a buy now, pay now company. That's what you're getting sold as the retail investor and as a consumer. That's really not their model. Their model really is to sell this buy now, pay now, later term agreement to take that yield and to sell that yield to somebody else, right? That's really what this model is. And therefore, if they lose the market to sell that yield to somebody else, or they can't get terms that they agree with, then there's really no justification for them to do the front end deal, right? Which creates a securitization that they now can sell to a secondary party for that yield. And that's the kind of things that you understand when you really start to understand how these markets actually work. Retail's being told, we got this great company, they allow you to buy a product and pay for it later. In reality, they're just trying to figure out a new way to create a ABS that they can sell to somebody else. And if they can't sell that ABS to somebody else, we may not be able to justify the business activity on the front end. So there's no question that the risk is being repriced, adding that demand for Affirm loans remains strong, and the company will re-enter the market when it's opportunistic to do so. Now, she's supposed to say that so I can understand. Okay, so we see that spreads on 3-year AAA rated bonds backed by auto loans with prime credit scores increased by 0.33 percentage points between February 3rd and April 17th. Over the same period, spreads on 3-year BBB bonds backed by subprime auto loans rose by 0.5 percentage points. So we're seeing is that the spreads are rising, which means that the market is demanding a higher yield on certain type of ABSs. And we're going to go a little bit deeper in that into this article. But what I want you to understand is that when you're looking at companies in the market, so first, do you understand the overall principle of the market? What everybody's trying to figure out how to get a return on capital. The savvy players are. The other people are investing because the company's trying to change the world. They're investing because we like the CEO. But the savvy people in the marketplace, their job is to get a return on capital. That's why they're doing what they're doing. They look for opportunities to get a return on capital based on the risk that they have to take, and then also based on the length of time in which they want to get that risk. If you're looking at a company and they're telling you what their business model is, but in reality, what they do is they take their particular loan packages or they take their financing deals and they package them into ABSs or also MBSs like you see in the real estate game. And then now they have the responsibility of selling that to somebody else to generate capital for those particular companies. So that they need those people to agree to the yields that they're willing to pay out. If they can't code the terms that are working for their company, then they're just stuck holding these things on their books, which puts them at a lot of risk, right? And so one of the reasons why we do what we do is to get people to understand these situations, because now they understand there's an opportunity for me to be successful in the markets based on me understanding this. But you gotta really be able to see, right, how that understanding can benefit you in your situation, the situation of your group. And it's got to be a little bit deeper than surface level. You understand me? And that's really why we're doing what we're doing. So hopefully that this video was important to you. Hopefully you get some value from it. Share it out, like it, let somebody know about it. We're going to continue to keep dropping little shorter term videos like this to kind of get a little bit more exposure to the algorithm. David W. Williams, talk to you later.